Hello ladies and gentlemen, and welcome to my finance and accounting education channel. My name is Alex Petrescu, and in this video today we are going to talk about two things. First of all, there will be a short introduction to my latest course called Key Performance Indicators, or short KPIs. And the second topic we are going to tackle today will be the third part of my presentation about saving and investments, and today we are going to talk about pension funds and insurance funds. But before we jump to the topics, just a short shout out. Please do not forget to subscribe to my channel, like, comment and share. If you like my videos, if you have anything to say about them, or if you think somebody would be interested in seeing them, please share them as well. Also, on the bottom of this video, you can also support me by other means. You have there link to eToro. You can buy on eToro shares, but not only. So if you intend to invest your money in this way, and you have this opportunity to invest the money without paying a commission or a fee for each transaction, then you have two links to Amazon. One is allowing you to get two audibles or two audiobooks for free. The other one is a subscription to the Kindle program. I also have a Kindle. Whether you prefer reading books or hearing them in the form of audiobooks, for each click and for each customer that Amazon or eToro is getting from my viewers, I will also get a little support for financing my channel. And last but not least, there is also on the bottom of this video, there is an Amazon wish list containing a lot of items which can help me improve my videos, better webcam, software, so Microsoft Office, the latest version, some editing software, a green screen for the background of my videos, a mobile solution for filming videos when I'm abroad or traveling, so a laptop, and so on and so forth. Now that we are done with the ways through which you can support me, we can jump right in and talk about the KPIs course. So the KPIs will be focusing on the financial ratios or indicators. For the non-financials, we had already discussed about them in the balance scorecard course. There you can find some suggestions. So with this occasion, with this course, there will be no KPIs that are non-financial in nature. However, there will be non-financial elements which get into the calculation. One simple example is the number of shares a company has. So the shares which are available on the market, that is not really a financial in nature. It's being established at the original moment when the company is either founded or when it's doing its first IPO, so initial public offering. You have, of course, the nominal value of the shares times number of shares, and that's the equity of the company. However, the number of shares of a company can vary. It can increase during the time. It can also be decreased. There are more condition in which the number of shares of a company can increase on the market. First of all would be secondary public offering, so when the company is getting some more capital for its investment, so it's issuing new shares. Another one would be options. So sometimes, for example, managers can get options as rewards for that performance, and they can exercise their option and get some shares for the company. Another situation in which the number of shares of a company is increasing is for example, if the value of the shares is too high, like in orders of thousands or tens of thousands of dollars, euros, whatever currency, and normal investors or people that don't have that much money cannot buy the shares anymore, and usually you can get a split. So all the share owners will get a 5-4-1 or 10-4-1 or whatever it makes sense, in order to reduce the value of each share and to get more share, and as a result we will get also more shares in the market. Then you can also have debt, so you can issue debt that is convertible to in equity at a certain point, and this will increase also the number of shares. And probably the most common way of reducing the number of shares in the market is when the company has a lot of money and wants to increase the value of the shares for the existing shareholders, and decides to buy back its own shares. And yeah, this is the way in which the shares on the market will get reduced. Now, if we have talked about the number of shares, which is a non-financial element which comes into consideration when calculating financial ratios, we are going to talk mainly about 5 categories of financial ratios or KPIs. We are going to talk about the revenue ratios, we are going to talk about profitability ratios, we are going to talk about gearing ratios, liquidity ratios, and last but not least the investor ratios. In this particular area, the number of shares the company has issued already being very important. Of course, for each of these categories, I will present several KPIs or indicators and approaches, and of course I will have some considerations, so explaining a little bit how the thing should work. So it's not going to be a course only with definitions and no clarifications. I will talk about advantages, drawbacks, how you should interpret them, the limitations, what other information you should consider when looking at these KPIs. And at the end, we will have a very nice example. Again, I'm going back to my favorite company, Tesla. I took some financial statements from the official Security Exchange Commission site, so official statements from the supervising authority of the stock exchanges in the United States. So the balance sheet and the P&L cash flow we are not going to use with this occasion, but they are deemed to be correct, more correct data than this publicly available. I don't think anyone can have. And also I have let's say a homework done by probably a student. I didn't found that much information, but it's also not very relevant. It's called the Tesla Strategic Financial Analysis. Anyway, it's filled with KPIs, many of which we have also in this course, and we will take a look on how they are calculated. There are some very interesting events in these KPIs, and yeah, it's a let's say it's a real life example. So the company is real, Tesla, and you will have to look into real financial statements, and you will see the challenges of finding the information, which is, it might be somehow defined in the let's say in the theory, but in the financial statements it has different names, or it's not really aggregated in the form you need very fast, or things like this. Of course, at the end we will have the conclusions, but before the conclusions there is also a small homework you can submit to me if you have specific in your industry, in your company, if you have specific financial KPIs. You can send me also this information, we can comment about them. Also, if you just heard about some KPIs but you don't know exactly how they work, or if the information they bring is sufficient in itself, or you need to correlate it with something else and things like this, I'm open, and you can submit this as a, let's say, as a homework, although it's not mandatory, and it's just let's say a way of interacting and getting my opinion if you choose to. Now that we are done with the introduction to my KPIs course, which remember is already available on Patreon and Udemy, let's go to the third part of my saving and investing presentation. This one has the motto, when the long term is not that long. Why? Because today we are going to talk about insurance funds and pension funds. We are going to focus, of course, for pension funds there will be a clarification about the pension funds in general, but we are going to focus on the third pillar because that's of interest for us, and I will explain you why. And then about insurance, we are going to talk about the classic, the two main types that I know of, that are the classic types of insurances and the unit-linked ones. Now, pension funds, there are basically 3 pillars. The first pillar is based on your salary. There is a taxation from the state. You cannot choose the level of taxation, so it's kind of fixed. It's in the legislation. You will get this pension when you fulfill certain criteria, mainly an age criteria, so up from 60 years old or 65 or 70, or it depends. And you have had a certain number of years of contributing to this pillar. So there is no investment to back it up. The pensions of the current pensionists are being paid by the people that work today, and the pensions of the people that work today will be paid by the people that work when they will be in their pension time. The pension budget can go into a deficit. That's very much related with the life expectation. So the lower the exit age, so the entry in the pension age, and the longer the people live, of course, will have a lot of years which these pensions need to cover. It's also related to how many people are born in that country, how many are working, and so on and so forth. So there are many conditions which are influencing this, but this is not very, let's say, very interesting for us, because you don't have any options, so you cannot influence it in any way. The second pillar, it's, let's say, a hybrid between the first and the third pillar, meaning that a part of what the state takes for the first pillar will go into this second pillar. So you also have no saying here exactly how much of your taxation or for the pension is going into the second pillar. However, there are several companies which are taking care of these pension funds in the second pillar, and you can choose one of them. So that's, let's say, it has a little bit of flexibility. It also, most of the times, you don't have access to the money. It depends. So you need to, based on local legislation, you might not have access to these funds also till your pension age. They have the same disadvantages as the, although it's a hybrid, as the investment funds, meaning that somebody needs to administer this pension fund. So you need to pay for the salaries, for the employees, for the pension funds managers, and so on and so forth, which is, of course, no matter how well they invest, it will reduce your take from the pension fund. And I personally consider that the efficiency of the system is doubtful, meaning that the number of options is limited. In any other investment that you choose, you can choose also different fields. If you remember from our first slide, you can put your money in shares, in bonds, in many other things. This money from the second pillar, you can only put it in pension funds, and only going only to a selected number of companies that are administering this. And sometimes the competition is not, there is not that much competition. So personally, I believe, and they know that the money are coming anyway, because it's automatic, and the percentage is established by the state. So there is not that much incentive to offer you too many rewards. Then we have the third pillar. It's 100% optional. So these are the ones that are really interesting for us, meaning that you can choose whether you do it or not. You can choose when you start saving for your private pension. You can choose how much you want to put in per month, per quarter in your system, and so on and so forth. The contributions can be tax deductible in some jurisdictions, especially if they have progressive taxation systems. Let's say for the second pillar, but also for the third pillar, you need to be careful which company you choose, who's behind it, the reputation, how many years they have been around, what are the average returns that they have delivered so far, how they are performing, and so on and so forth. So you always need to look at this, and you also check a lot of you need to check a lot of conditions. For example, if you get into trouble and you can no longer pay, if you can stop the payments, can you withdraw the money that you have already put in the system if you need it for something that's urgent? Can you do that in full at some point, or you can already start receiving like a pension earlier? Are there any penalties to be paid? How much, based on at the beginning you are committing yourself for a certain period till your pension age to contribute with a certain amount of money, and usually they tell you how much is the guaranteed pension that they can offer you for if you go through with your plans till the required age. So how much is that? And it's as I have said, it's 100% voluntary, so it's a long-term commitment. So of course, if you enter in the system at 60 years old and your retirement age is 65, it's not such a long-term commitment. But for most of the people, if you enter around 30, maybe not in your 20s, because maybe you don't make that much money in the 20s, but if you enter in your 30s, you might have 30 to 35 years of contribution. So do mind that it's a long-term commitment. It's not like a current account in the bank. I'm putting some money now, then I'm taking it out, and this kind of behavior is not very beneficial. So then you have the insurance funds. There are two main types, so classic and unit linked. Both of them are like the third pillar, so they are 100% voluntary. You can do it or not, as you like. They are also long-term voluntary commitments. They need not be that long, so there are 20, 25, 30 years, so not necessarily so much, 35 years or 40 or something like that. The same, be wary about the reputation of the company who's administering, how large they are, how safe they are. The classic, both of them can have, so not only the classic but also the unit link can have two components. You get insured against a certain bundle of risks or only one risk, like in case you die early from accidents, or in case you can no longer work, so you have an accident and you can no longer work, and things like this. And that's one component, and the other component is working like a saving, and investing. For the classic ones, they are usually less riskier. You have at the end of the, let's say, 20-25 years, you have an amount which you already know at the beginning that you are going to receive at the end. They are less riskier because they are usually also going in the area of money markets, so investing in bonds, in very safe monetary instruments, so not really crazy like things like shares or options or things like this. There might be penalties for early withdrawal. Most likely there are penalties for early withdrawal of your funds. For example, if you are halfway through your lifetime and you have paid for the so like half of your total contributions, you might get only 20% when you decide to withdraw. So do mind this thing when you commit yourself for such a long period, 20, 25, 30 years, that this is no joke. Today I have an insurance and tomorrow I don't have it, or it might cost you a lot. Also, you should be able to stop your payments. There might be also penalties. Do check the conditions. They might have another a second tier of insurance which is backing up your payments. So conditions apply. There is no one size fits all. And then you have a hybrid system, which is the insurance funds in the forms of unit linked, meaning that it's somehow half insurance, half investment fund. It can also cover some of those risks that I mentioned, so the risk of invalid, so not being able to work, the risk of dying, and so on and so forth. And then you get units in a fund which they are administering, just like an investment fund, and based on a certain risk profile that you choose, they can go more in riskier area, like in owning shares or things like this, or they can also stay a little bit safer and putting your funds into the money market. There might be also conditions for payment stops or for early withdrawal, but they tend to be a little bit more relaxed than the classical ones. Why? Because the insurance funds are making more money with a little bit being more relaxed with their strategy. They are making more money with your money, let's say, and then they can offer you better conditions. So when you decide not to no longer invest, they can say, okay, for the next 10 years you can keep the money with us, or you just get the current value of the units you own, and so on and so forth. And there might be no penalties. The withdrawal might be very fast, and so on and so forth. And just as in the case of the third pillar and I have already said, of the third pillar of pension, you need also to pay the middlemen, so the ones that are administering these insurance funds. Now, talking about rating, I have introduced you this rating last time. I said it's not that easy, because when you choose an instrument and you say, okay, how risky that is, it depends within the instrument. So based on your contract, I'm trying to do a little bit of benchmarking. And I said, okay, for the pension funds, third pillar, I said I would give like 2 stars of risk. So they are not extremely risky. They are a little bit more riskier for sure than the bank deposits, because bank deposits are usually guaranteed up to a certain point. And I said that it should be about the same as the investment funds from my point of view. Then I said that if we are talking about the liquidity, okay, liquidity in this sense, we need to think that you can get penalties, so it's certainly not that liquid. And also the fact that you need to pay for till 65 years old or something like that. I rated it as being less liquid even than the bank deposits, far less liquid than investment funds. And rewards, I said that it might have the same or similar rewards as the investment funds. Now, if we're talking about insurance funds, classic one, I wanted for risk, I wanted here to give like 1.5 stars. Why? Because they are also very conservative. They are not as, let's say, safe as the bank deposits, but they are also not as risky as the investment funds. The investment funds reduce the risk through diversification and things like this. In the end, I gave them also something like 2 stars, so they are not extremely risky. Liquidity also 2 stars, so it's the same. You have 20 years, 25 years in which you need to keep the money there. You might lose a lot of money if you take it before, so they are not very liquid. Let's say you cannot say tomorrow I want all my money back. And the rewards, I said that they are also in this area. Let's say a little bit more than the bank current accounts or deposit accounts, but they might, because they have a little bit of freedom, and because it's on such a long term, they might deliver better rewards than let's say a bank deposit that is on 6 months or on 1 year or on 2 years, because they are on 20-25 years and so on and so forth. They should deliver a little bit more rewards, similar to pension funds of the third pillar or investment funds maybe. And then we have the unit linked, which are crazy risky, not 100%, so I gave them 4 stars out of 5, because they can go, especially if you choose the ones which are investing a lot in the shares. So yeah, the value can fluctuate like this, and I have seen it. It's following the overall business cycles. If there is a market crash or a crisis, or like the pandemic or the 2008, the value of your unit-linked insurance fund would also drop. So it's not that stable. Liquidity is also, because they are still on the long term, you get penalized and so on and so forth, so the liquidity is also not fantastic about them, so I give them 2 stars out of 5 for liquidity. But you get better rewards, so here you can really get good rewards, because potentially there might be a lot of shares included, and I gave 4 out of 5 stars, so you can really make a lot of money with unit-linked insurance funds. Thank you very much for your attention. That was the second topic we talked about today. So the third part of my investment and savings. First we need to save and save. So savings and investments commentary. Just a quick shout out once again. If you like my video, please do not forget to like, to comment if you have something to add. To share it if you think somebody would be interested in seeing it, and most important, to subscribe to my channel. You get the chance of seeing very fast the videos that I'm releasing. Those will be, let's say, the less costly options and the easier options for you. More complicated is when you want to have a trading account or for your securities, basically for your financial assets. So and you can open it through eToro. The link is also below, and you won't pay any fee or commission for your transactions, which is beneficial even if you don't do that many transactions. Of course, any dollar or euro saved is very good. Also, if you would help me a lot, because I will also get a part from your buyout on Amazon, and both the 2 free audiobooks or audibles as they call them, or if you join the Kindle program. And the last version, which is, let's say, the most difficult for you and the most expensive, should you choose to support me directly with my wish list from Amazon, you can buy 1 or even more things from that list for me, and they will help me to improve the quality of my videos. There you have a better webcam software, so a better Microsoft Office version, better version of the software editing that I'm using, of the editing software that I'm using right now, a mobile solution like a laptop, which I can keep on doing videos even if I'm not at home, a green screen for making the videos. Yeah, maybe I can get rid of the mirrors behind me, and so on and so forth. Once again, ladies and gentlemen, my name is Alex Putescu. Thank you for your attention, and I look forward to seeing you with my next video.